So the next paper is going to be presented by Alessandro di Nola from the University of Constance. And he will be talking about rescue policies for small businesses in COVID-19. So Alessandro, go ahead.
Thanks. Can you see my slides?
Yeah, very clear.
Okay, yeah. So I'm really glad to be here. So this is a project with Leo Kass and Haomin Wang. In this project, we look at government credit subsidies for small firms in the US during the COVID-19 recession. So let me jump directly into the motivation. So the COVID-19 recession differs in a number of important ways from a standard business cycle downturn. First of all, the COVID pandemic caused a very large drop in economic activity, but this was relatively short-lived. From the following figure, we can see that here we show the evolution of output, private investment, consumption, and employment in the US economy over 2020. So we can see that if you look at the blue line, we can see that there was a very large decline in output. So in the second quarter of 2020, output went down by more than 10% in the US with respect to the pre-pandemic quarter. But then it quickly rebounded and it quickly went back to the pre-pandemic level by the last quarter of 2020. There was also a considerable drop in consumption. Consumption dropped by almost 10%, but again, it quickly rebounded after that. So the second striking feature of the COVID recession is that the impact of this recession was highly asymmetric on firms. So there was a lot of heterogeneity going on. And in particular, the impact differs greatly by firm size. Small firms were hit much harder than large firms during the recession. They experienced a greater drop in sales and employment. The United States allocated more than $600 billion for the Payroll Protection Program in 2020 in order to support small businesses. So this Payroll Protection Program consists of forgivable loans at a very convenient interest rate, only 1%. And the loan can be up to 2.5 times the average monthly payroll of the firm. So a firm that has employs more labor will get a larger grant. And only firms with less than 500 employees are eligible for the grant. The grant was quite successful in the sense that the take-up rate by the end of 2020 was 67%. So 67% of all eligible firms did apply for the grant and they received it. And as of November 2021, almost a very considerable fraction of these PPP loans were totally forgiven. So basically, firms didn't have to pay them back, and then these loans were basically a grant given by. However, little is known about the macroeconomic impact of such policies on heterogeneous firms, and this is what we want to investigate in this research project. So, as I was saying, we study the effects of small firm rescue policies on these macroeconomic outcomes. What is the main trade-off here? What are the pros and cons of giving these huge grants? So first of all, of course, giving credit to small firms can prevent productive firms from shutting down, and this avoids inefficient liquidation of capital and will allow productive firms to continue operating, and this will facilitate a more speedy recovery. On the other hand, however, such rescue plans can inadvertently prolong the lives of unproductive firms. So you can create these so-called zombie firms. And this can hamper the efficient reallocation of capital and labor in the economy. So what do we do in this paper in order to address this question? First of all, we build a general equilibrium model with heterogeneous firms that face financial constraints and capital irreversibility. We calibrate the stationary model and the pandemic shock to the US economy, and we take into account the payroll protection program that was put in place by the United States government. And then basically we use our model as a way to assess to perform some policy analysis. So in particular, we compare the Paycheck Protection Program to a counterfactual scenario where the government did not help firms. So it's a counterfactual economy that we call laissez-faire, where basically the government didn't put in place any rescue policy. We also analyze rescue policies with different generosity. So what would have happened if the US government had enacted an even larger rescue policies? Or what would have happened if maybe the government would have been more prudent and put in place more, smaller policies? And this this is probably I won't have time to show this today, but we also want to simulate the effect of these rescue policies in the context of a typical recession. So not the COVID recession, but we think more of a business cycle downturn, which is less severe, but more persistent. So let me give you a preview of the results. So based on our model, we find that the Paycheck Protection Program prevents really many firms from going bankrupt. So it prevents 60% of small firm exits at the onset of the pandemic. So the PPP is very effective in preventing business failures. However, this leads only to a modest increase in welfare, and it is mostly ineffective in improving aggregate output and employment. And why is it so? Here the mechanism is that these rescue grants, they slow down the reallocation of capital and labor towards larger and less impacted firms. So when a shock arrives, of course, in the economy, it would be optimal to reallocate resources towards larger firms that maybe operate in sectors of the economy that were less impacted by the pandemic. Okay, so things about, for example, streaming services versus movie theaters. And a second reason why the rescue policies put in place by the government are not very effective in terms of aggregates, that these grants, they save relatively low productive firms. But these relatively low productive firms account for only a small fraction of total employment. Our results echo also previous findings in the firm dynamics literature that show that small firms, on one hand, experience more volatility, so they are hit harder during recessions, but this has only modest impact on aggregate fluctuations. And this implies that small firms' credit policies are likely to have a more limited benefit than it is commonly assumed. So in order to analyze our question, we build a general equilibrium model where each period is a quarter. We have two sectors, small firms sector, where most of the action will take place, and a corporate sector. We think of the corporate sector as, large firms that have easily access to capital markets, and therefore they were not impacted so much by the pandemic, at least from a financial point of view. The small firms are firms that are heterogeneous in productivity and capital. They face idiosyncratic risk and collateral constraints. So there is a form of capital market imperfections, and they can choose in every period whether to, enter in the economy. And once they are operating, they can choose whether to stay in operation or to exit the economy. These firms are owned by representative households. And then we are going to study a steady state model which we perturb with a one-time unexpected pandemic shock that will change the productivity in the economy and will also change the preferences of the households. So let me talk briefly about the structure of the model without showing too many equations. So we have that small firms produce output using capital and labor. This is standard. We have two kinds of frictions. The first friction is capital irreversibility, and the second is financial frictions. In terms of capital irreversibility, firms are allowed to operate only with a fixed amount of capital that either own, so they buy part of the capital upon entry, or either they rent. And this captures the idea that many business owners in small firm, they actually rent or lease part of their capital. And the friction here is that when the pandemic shock hits the economy, they cannot easily sell part of their capital. They cannot easily downsize. So they might be forced to stop operating. The financial frictions are that the small firms can only borrow against the collateral value of their capital. So they are not free to borrow as much as they need from a bank. Also, the small firms cannot raise equity from outside investors. So they cannot go to their shareholders and ask for additional funds when, for example, the Covid recession hits the economy. And we think that these assumptions capture quite well the financial environment in which small firms operate in the United States. So that in terms of decisions, the firm would like to exit if it cannot pay a positive dividends. So this we call this scenario forced exit, or if the value of the firm is lower than its liquidation value. So in that case, the firm could continue operating, but find it more profitable to leave the market and resell the capital it owns. There is also entry. So in every period, there are some potential entrants who draw some productivity, debt, and capital, and they decide to enter whenever the value of their firm is greater than the entry cost. So let's move now to the pandemic shock. The economy is in a steady state when all of a sudden the pandemic shock strikes in the first period in the economy, which is basically the second quarter of 2020. This shock has four components. So there is a shock to the corporate sector productivity, a shock to the small firm productivity, and then there is also a shock that affects the marginal utility of consumption. So when the pandemic arrives, households might, maybe there are some stay-at-home orders, so they cannot go shopping, and this creates a negative demand shock. And also, when there is the pandemic, households might be afraid to go to in-person work, and this reduces the amount of labor supplied in the economy. So we also have a labor supply shock. This shock has a persistent parameter rho, so it hits the economy in period one, and then it will decay exponentially. Then the government wants to alleviate the impact of the shock and gives a rescue grant. This grant is only given in the first period. There is an exogenous fraction of firms that are eligible and can receive the grant. And the grant amount is 2.5 times the firm's monthly payroll in normal times. So this is basically what happened exactly what happened in the US economy according to the PPP program. And grants, we also make this assumption that grants do not need to be repaid, which maybe is a bit extreme, but in the data we observed that over 90% of the PPP loans issued in 2020 have been totally forgiven. So this is maybe not a restrictive assumption. In terms of data, we use standard data that are publicly available, and also we use confidential data from the Kaufman Firm Survey, which is a longitudinal survey of a cohort of startups from 2004 to 2011, which has very rich information on financial variables. We can observe the firm's balance sheet. So in terms of, we of course calibrate our model so that it can match some stylized facts, the US economy. And we see that the model can replicate quite well, for example, the fact that incumbent firms are typically larger than entrant firms. So typically when a firm enters the economy, it enters with fewer employees, and then it will slowly grow, hiring more people. And in the paper, we provide a lot more details on this. So in terms of matching the firm size distribution, we match the fact that the distribution is really skewed in favor of companies with fewer employees. So in particular, our model is able to reproduce the fact that around 80% of US small businesses have less than 10 employees. And only a very tiny fraction, 1.7% of businesses, have more than 100 employees. But of course, these larger firms account for almost 1/3 of total employment. Let me also give you a preview of the decision of a firm whether to exit or to continue into operation. This figure plots the decision to exit or not by putting debt on the horizontal axis and by putting productivity on the vertical axis. These are the two variables that the firm can observe. Based on these two variables, the firm will decide what to do. We see that firms with low productivity and high debt will decide to exit. And among these firms who choose to exit, the ones with higher debt will be actually forced to liquidate. Whereas the ones with less debt, they will choose voluntarily to exit. So they could continue to operate, but they are not productive enough so that this is not very worth it. In the interest of time, I'm gonna skip the calibration of the shocks. Let me just say that we calibrate the pandemic shocks so that we can reproduce a number of stylized facts that we observed during the pandemic. So we can match the drop in total output, the drop in consumption, the drop in employment in small firms and in the corporate sector, and so on and so forth. And let me jump into the main results of the paper. So in this figure, I show the impulse responses, so how a number of interesting variables in the economy respond to the pandemic shock. In the first panel on the left, you can see that when the government gives the grant, so the baseline grant, this baseline grant can prevent up to 50% of firm exit in the economy. So it's very effective at saving small firms. At the same time, we ask also the question, what would have happened to small firms' exit rate if the government had done nothing? So if the government had done nothing, which is the scenario that we call laissez-faire, then there would have been also a considerable increase in exits. So around 10% of the exit rate of firms would have increased by 10%. So from this first figure, we can conclude that the rescue policies put in place by the US government were really very, very successful in saving small firms from bankruptcy. And this is reflected in the graph here below on the left, where we show the impact of the grants on total capital in the economy. Again, distinguishes these two scenarios. So what happened with the grant, which is the blue line, and the counterfactual of laissez-faire, which is the red line. And we can see that with the baseline grant, there was a big increase in capital on impact. Again, because many small firms were saved. But this actually, this increase in capital was very short-lived. So after only a couple of quarters, this additional amount of capital created by the grant faded away. And actually the recession, at least in terms of capital, was longer-lived. In the laissez-faire economy, instead, on impact, many small firms would have gone bankrupt, so in capital. But then this capital would have recovered relatively faster, and it would have gone back to the steady state level relatively faster. So these are basically the main findings of the paper. So we have also more in the paper for everyone who is interested. Let me jump then to the conclusion. So in this paper, we analyzed the macroeconomic impact of small firm rescue policies in the COVID-19 recession, and we use an equilibrium model with heterogeneous firms. So what is the main message from the paper? The main message is that rescue policies, they greatly reduced small firm exits, but this had only a negligible impact on aggregate output and employment. And the reasons were the following, is that the grant reduces the reallocation towards the corporate sector, which is the sector that is less impacted by the pandemic. The grant also saves relatively low productive firms. And these relatively low productive firms that are at the margin between exit or not, they don't account for much employment in the first place. And in terms of future work, we would also like to understand what are the effects of small firms' rescue policies in different types of recession. So, for example, the Great Recession in 2008. Thanks for your attention.
Thank you so much, Alessandro, and thanks for handling so smoothly the hiccups that we had. So the discussion discussion will be opened by Jean-François Wen. He's also from the IMF, from the Tax Policy Division. So Jean-François, go ahead.
Thank you, Ruud. I'm just about to share my screen. Can you see it?
Yeah. Can you maximize the size? In presentation mode, or?
Sorry, I'm just looking for it. Well, let me just use this as the talking points. In any case, it's not that important to see exactly what's on there. So first of all, it's a very impressive paper. So congratulations to the authors for constructing a very detailed model to simulate the impacts of rescue policies. And what I'd like to do is spend maybe 2 minutes just reviewing the basic structure of the model in non-technical terms so that the audience understands what the ingredients are. And then I'll raise a few questions for discussion. So the basic setup is that there are two sectors. There's what's called a corporate sector, which has large firms, and their distinguishing characteristic is that they have unconstrained access to capital, which means they can borrow and issue new equity. Whereas the small business sector are firms that are not able to issue equity, and their borrowing is limited by their available collateral. And the other important ingredients are that small firms differ in productivity levels and debt levels. And so that means that when the pandemic shock hits, some of these small firms will be unable to pay their rent or their payroll, and they will be forced to liquidate. Some other firms will not be forced to liquidate, but their balance sheets will have been so damaged, to put it that way, that given that there are also, even after the pandemic, there are going to be inevitable productivity shocks in the future, some of these firms will simply choose to exit, even if they haven't gone bankrupt during the pandemic. And then lastly, new firms can enter. But there's a fixed capital cost to pay to enter the market, so only very productive small firms will enter. That's the basic setup of the story. And then the pandemic shock has two types of shocks. One is a supply side shock. So there's a one-time drastic reduction in the productivity of a certain proportion of firms that would correspond to the sectors most impacted. And then households also have a reduced taste for consumption during the pandemic. So there are two sides of the shocks. And then, the rescue policies are low interest loans with no collateral required, but it's being provided through PPP. There's also grants that could be unconditional grants or forgivable grants. And in the model, these I think are viewed as the same. And of course, they're forgivable only if they're spent on wages, if the loans are spent on wages and fixed expenses. I won't review the findings. I think Alessandro explained them. So let me just go straight to discussion questions. I'd like to know, the effect of some of the other possible policies that have been enacted where there's a requirement that the firm suffers a significant revenue decline before they qualify. I don't know if this would change the results, but it would be interesting to think about it and whether these are good policies. So for example, the second draw PPP program required a 25% revenue fall before the enterprises qualified for these rescue loans. Also, the employee retention credit is a refundable tax credit on Social Security taxes, and it requires a 50% revenue fall. So that might change the dynamics. And on the tax side, the employee retention tax credit depends on payroll. It doesn't depend, for example, on other fixed costs. So that could have different impacts. Another feature of the model is that the financing of the rescue policies is with non-distortionary taxes. that is with lump sum taxes, which means that in effect, the government doesn't need to worry about the timing at which it repays its debt. So a natural question, and of course, an important question in reality is, if these taxes have to be financed by distortionary taxes, like taxes on labor, then the debt repayment schedule, is going to matter. Whether you've considered how to model that and whether you're able to say anything about it. Well, let me just skip to one last comment that's not on my slides. When we think about small businesses versus large corporations, I think something that all of us intuitively have in mind is that there are externalities, at least people perceive, that small firms, independent small firms, have neighborhood externalities that the Amazons don't, and so that's not factored into the calculation. So those are my comments, questions and comments. Thank you very much.
Thank you so much, Jean-Francois. This is very interesting questions. And there's one question also in the chat, so we'll give the floor to Christos before I hand back to Alessandro to give a response to your questions, Jean-Francois. And then, so Christos, do you want to come in and ask your question?
Yes, Ruud, absolutely. Alessandro, thank you very much for a wonderful, very interesting presentation. I just wonder whether you would propose a more targeted approach to this assistance, and if yes, what kind of characteristics do you think would this approach would have, this targeted assistance would have?
Yeah. So this.
Okay. Yeah. Go ahead.
Yeah. So thanks a lot for all your very interesting questions. I will start answering Christos' questions, which is quite interesting because we are actually investigating now in the paper, which is a work in progress, what would be the impact of a more targeted grant. So suppose the government, instead of giving these loans to every firm in the United States with less than 500 employees, which is would condition the grant on some observable characteristics. Of course, in the model, it would be optimal to condition the grant on firm productivity in order to avoid the rescue loan being wasted on low productive firms. But firm productivity is typically, of course, not observable. So one way could be to condition the grant on employment and say that you want to target like a particular firms, for example, with at most 20 employees. So in this way, you could, with the same fiscal resources, this could have a maximized effect. And so this is an interesting point, and we are investigating this. And many thanks also to Jean for the excellent discussion. And let me answer just a couple of interesting points that he raised. So first of all, in the model, we assume that the government can finance these rescue loans with lump sum transfers, lump sum taxes on the household. And the implication would be different, of course, if we assume the distortionary taxes. So my guess is that this would further reduce labor supply, because then the government would have to finance these rescue loans by taxing with the payroll tax or by taxing the labor income produced by households. It's also very interesting to look at neighborhood externalities, and this can be a reason why the governments they really like helping small firms, because if this is not incredibly effective in terms of aggregate output in the economy, small firms, small business ownership is still very important for communities, right? For neighborhood, it fosters a sense of trust, and it creates employment opportunities for people. So this can be one of the reasons why saving small firms is a good idea, even if this doesn't have a dramatic impact on aggregate output and aggregate employment. And maybe if I may add, actually, another very interesting point is to look to compare forgivable loans versus unconditional grants, and this would have a selection effect. So we are doing this in the current work, because of course you would have that only the good firms who are reasonably productive and have some chance to survive in the future would take up a loan, because they know that they can repay it. Whereas the bad firms, the so-called zombie firms, would not take the loan, but would take this unconditional grant, because this is basically free money that the government is giving. Yeah.
Thank you so much, Alessandro, and thank you, Jean-François, for this excellent session again. This is a very important topic, I guess, for many countries, also when they unwind the support that they have been given, facing this trade-off. So very interesting to have this systematic approach to it.